My guest today is a partner at the largest professional services firm in the world, Deloitte. She's also the founder of Deloitte's venture capital arm in Canada, Deloitte Ventures.
Today, just getting a 3 or 4 year degree sometimes doesn't get you really that far.
Why did you stay in corporate so long?
We were breaking a lot of boundaries within the firm, and we had to figure out what we were selling, who we were selling it to, how we were going to get the skills to sell that.
How has AI changed the way you operate as a venture investor?
One of our associates can do the work of almost 2 associates now.
But at that stage of investing, how important are the founders?
We're not always looking for something like a sexy problem. Like sometimes a really simple problem and getting to market quickly with it is totally fine. There's too much foreign investment coming into Canada that should be replaced by Canadian investment.
A lot of people I speak to are kind of struggling between launching a business and staying in their safe corporate job. What advice do you have for them to help them figure that out? Like, would they go take the risk or stick with what they're doing?
There's one answer to that question. I think, again, it comes down to like...
Talia, thank you so much for joining us. You have an incredible career. But why don't you take us back? How'd you get involved with Deloitte? Where'd you go to school? All that fun stuff.
Cool, yeah. So I went to school at Western, the Ivy School of Business. So I started 2 years in Western undergrad, something called Scholars Elect. I didn't know what I wanted to do, so I took a whole bunch of courses. If you maintained an average of whatever it was at the time, you could take whatever you wanted. So I did a little bit of physics, a little bit of music, a little bit of nutrition, a little bit of math, a little bit of business, and finally found myself sort of really focused on business more so and really interested there, and went to the Richard Ivey School of Business and graduated.
By the way, for the people that don't know, Richard Ivey School of Business, it's like the Wharton, it's like of Canada. It's one of the best business schools, certainly in the world, but the best business school in Canada, unless you're from Schulich, which I am from, but it's considered very hard to get into and stay in. So anyways, yeah.
Thank you for that. So I guess I was recruited right out of school by Deloitte, firstly into risk consulting. That's what they called it at the time. But that was a fancy word for internal controls testing.
Which is a fancy word for something else?
For internal audit.
Internal audit.
Internal audit, which I'm not an accountant. And anyways, it just wasn't for me is the short answer. I spent a summer doing it and was really grateful for the opportunity, but said, this isn't for me. And they said, well, Deloitte's a really great place. Where do you want to go? And we got lots of things for people to do. And I had a real passion for valuations. I took that class at Ivy, absolutely loved it. And they actually had a profession called valuations. And so when I found that out, I was like, oh my gosh, okay, yeah, I want to go there. I want to do that. They're like, cool, but they don't hire anybody until you've gotten your CA and then you've practiced in the audit function for 3 to 5 years, and then you can join that group. Anyways, I was a little bit scrappy at the time, maybe still am today, and was the first person hired into that group out of school. I was like, you need somebody to print stuff for you, bring you coffees. That time people did that, and now you don't do that to your interns anymore. But anyways, I joined the team doing that. And quickly was a key member of the team and learned so much, and it was amazing. I became a chartered business valuator. I am a chartered business valuator, which is the designation for valuations in Canada. And so that's really where I cut my teeth at Deloitte. So did that for about 7 to 10 years or so. I then moved into a bit of an operational role. One of the partners from the valuation group became the managing partner of the whole financial advisory M&A business at Deloitte, and so I joined him as the chief operating officer of that business. I always had a passion for entrepreneurship. My parents are serial entrepreneurs. I would say more out of necessity. Immigrating to Canada, that was their only option, or so they felt. And so it was a real family business. We were in the called the schmutta business, but we sold drapes and bedding and bathroom accessories and things like that. And from the age of 10, I was working in the store. And I just always had a feeling that I was going to build something. And so, in those 7 to 10 years while I was in the valuation group, I always had a business plan going on the side. I was starting a baby food company, or like a safe company for how to lock your stuff up in a dorm room in university, like random things. But I was, doing valuations in the context of M&A, and those things really ebb and flow, and you tend to work really late hours, and then the side hustle would go to the wayside. I found that by sort of moving into that chief operating officer role, I was now operating what was then a $300 million business. So for me, okay, I wasn't starting a business, but I was operating a business at scale, and I was getting to learn the ropes of marketing and sales and finance and everything that goes into really running a business. And so that was a tremendous learning opportunity for me. And it was honestly just amazing.
Well, maybe it's actually a good point to kind of talk more about Deloitte and how they're structured, because Deloitte's doing like 70 billion in revenue.
Yeah, globally, for sure. Yeah.
Right? And to do that, I mean, you have to have an incredible scale, but it does operate like several small businesses, right? Like it's a very flat organization as far as I understand.
Yeah. So, I mean, structurally today, we've gone through a few different reorgs and how we classify things, but there's four main businesses. There's the consulting business. There's the kind of advisory business, which is strategy, risk, and transactions. We got a tax business and an audit business. So four main kind of pillars, I would say. But within that, you have partners that run in each of the offerings, right? Valuations, M&A, transaction services, diligence, you name it, corporate finance. In corporate finance, you've got 10, 20, 30 partners. Each of those partners manages their own book, right? In corporate finance, as an example, we're structured by sector and region. So you'd have a partner running TMT East, and they would run that book of business, and they would, it would be up to them to create eminence in that market, generate clients and all that sort of stuff. So it is very entrepreneurial in nature. Like even when you're running your book of business, you hire your teams, you train your teams, you go out and build markets for yourself, adjacent markets, and that's how you get growth. So generally, Deloitte allows for a very entrepreneurial culture to begin with. So yeah, it's a fair point.
All right. So you're essentially running, like you said, you're operating this business within Deloitte. $300 million is pretty significant.
Yeah. So that business was one of the four, let's say, right? So it was one of those big businesses that rolled all those partners up. And so we were running the platform for all of them to enable them, and the staffing functions and the finance functions, and what campaigns should we run and what offerings should we offer to clients and what should we buy next and things like that. So yeah, it was amazing. And then after that, once you fix it up and like you optimize the processes, at some point it's like, okay, an operations role is amazing, but I sort of liken it to like a firefighter. Like you're keeping the place from burning down where like nobody even ever saw smoke. And so it's like a lot of problem solving, which is super interesting. But over time, once you've seen the problems kind of repeat themselves, the learning, I think, plateaus to some degree. Anyways, had the opportunity. Deloitte was starting at the time. We had 5 businesses. We were starting our 6th, which was the artificial intelligence business. That was in 2018. So I helped launch our artificial intelligence practice at Deloitte, and we grew that business to 500 people or so over the course of 24 months. We were hiring like 1 or 2 people a day. So different operating challenges than we did running the $300 million business I spoke about before. We've never scaled a business like that at Deloitte, and you're now hiring scientists and getting into, managing different people than we have before. And so understanding the pay scales that are associated with that and everything. So that was amazing. And then I had my second child in 2020, I should know, in 2020, a few weeks before lockdown. She was born February 25th. Right before the COVID pandemic lockdown, and so I took a year off because the world was upside down. There was nothing to run back to work for, as I did with my first kid, and so took some time. And then when I came back, had the opportunity to explore what it would be like to have a venture fund within our firm, and so it's something we've talked about as a firm for many years, actually probably about 30 years or so. And our CEO just said, okay, I'd love for you to explore this and decide whether this is a path we're going to go down, or let's just stop talking about it because it's just a distraction. And so I did that over the course of a few months. And then by November 2021, we got board approval. And January 22, we launched the venture fund. So it's a $150 million fund off the balance sheet of Deloitte Canada specifically. And we invest in Series A and B stage companies that have some degree of alignment to what Deloitte does and where we can help them accelerate their growth.
So when you were operating this part of the business and even the AI practice, did you feel that like scratched the entrepreneurial itch?
Yeah. Like that AI practice, like the managing partner and I would work on that, 18 hours a day. And there was always something to do. And there was always something to fix or to build, or we had to figure out what we were selling, who we were selling it to, how we were going to get the skills to sell that, like what degree of investment should we be making in new product development, which at the time wasn't a big thing that we were doing at Deloitte. So we were breaking sort of a lot of boundaries within the firm. And so, yes, it totally did feel like a startup.
That's great. So even the AI piece, were you technically, did you understand AI at the time? Like, how did you learn? You're building a business in that space, a consulting practice in that space. How did you start to learn about that?
I'm still learning about that. Is the truth? It's complicated for sure. So no, I'm not a data scientist. I'm not an engineer. So I'm just learning about it as anybody else would. And I mean, it's a lot easier now with great AI tools to learn about this stuff.
Yeah.
But at the time, I would just have the team teach me, right? And they would say a word, and I wasn't shy to say, what does that mean, and how does that work? And but part of it was like, you know, we were doing great science, but I was the operator and making sure that whatever it was that we were doing, was it profitable? Was it valuable to our clients? Like I was anchoring us on different things. We had great people who knew everything about AI and the science behind it. Not everybody needs to do that. Same on the valuations team. Everybody on the team, actually me and one other guy, were the only non-CAs on the whole valuations team. Because we did a lot of valuations for financial reporting. And so the thinking was you needed to be an accountant in order to do that. But we also did a lot of valuations in the context of tax and in the context of M&A. And sometimes, people thinking in different ways is just additive, right? So which we know now with the science, actually.
Right. So you were involved in valuation. That's actually pretty interesting as a venture investor. So I assume that all the models that you have about valuations completely useless when it comes to venture investing. Like stick your finger in the air. It's like, this pre-idea AI company is worth like $300 million now.
Yes. It was very difficult to make the transition into venture. It certainly flies in the face of a lot of the
principles.
yeah, the principles and the foundations of valuations
and decency and sanity and all this stuff.
So yeah, it was. It's definitely not anchored in sort of the real theories of valuations. And I mean, you can't do a discounted cash flow, and you can't do a lot of these things. And the multiples you're looking at are crazy relative to market multiples. But yeah, I mean, a lot of it just comes down to scenario testing and exit analysis, really.
Right. We met while I was at managing director of a corporate VC firm, $100 billion market cap corporate, big software company that acquires a lot of software companies. And they are very disciplined when it comes to acquisitions, like the most disciplined in the world, I think.
Yes, very. We're not allowed to say their name, I guess.
No, we are. I could say that.
Okay.
Because it's been made public already. It's Constellation Software. Okay. I was managing director of their venture capital arm for a few years. And it was very interesting culturally because they're so like, if the price of the deal goes up by a margin that makes them uncomfortable based on the way they model things, like they'll say no to the deal, months of work down the drain. They're just so disciplined. I'm coming to my investment community, I'm like, it could be 10x, 15x, 20x revenues. Is like, I'm getting all these like, just a culture, a clash of cultures and philosophy and ways to deploy capital. Of course, they make a ton of money, so they're doing something right, of course.
Yeah, it's always good to, you learn something everywhere you go and you just put it in your toolkit, right? Yeah. And it just sort of helps frame the way you look at the next thing.
Right. So when you went to the CEO and you said, okay, let's proceed with the venture fund, what was your investment thesis? Like, did you say we're going to target this kind of business at this stage? I know you said Series A and B, but what elements of the business were you looking for?
Yeah, so the thesis really came down to the fact that Deloitte, in certain spaces, say cyber, future of work, AI, businesses that we're in, right? We would have market intelligence at our fingertips just by virtue of serving clients in those spaces. So we serve, the Fortune 100 on their cyber needs. And so we understand how the risk of cyber is evolving, the solutions that currently exist in the marketplace, and where there are gaps. Like we have that at the ready. And we have that almost at such a detailed level that would be more detailed than a generalist investor, right? Mm-hmm. That we believe would make us better investors in that vertical, cyber as an example. Then on the back end, if you say, okay, that solution solves a gap and, solves a client need and all that sort of stuff, we're not trying to, we don't provide any exclusivity to the companies we invest in, but what we're trying to assess is this one of the 3 best companies in market that would solve this potential problem for our clients? And if you can say yes to that, then on the back end, you should have your partners that are front line with the clients coming back to the venture fund and saying, we need that solution. Mm-hmm. My client needs it yesterday, right? And so the thesis was you can now plug it into your client base. Most CVCs are plugging it into themselves, right? We're a channel partner to plug it into our clients. So the distribution arm, given we're a $70 billion company globally is massive, right? So the thinking was we'd be able to accelerate their growth through our channel if we get conviction in it, and then everybody would win. Our clients would win by getting a great solution. The portfolio company would win by growing more rapidly, and then we'd be a participant in that value creation equation by virtue of having an investment and by virtue of serving those customers. So that's sort of the thesis and how it was planned out. And so we picked the verticals based on where we saw the most technological advancement. So cyber, the future of work, health tech, data and AI, fintech, and climate tech are our sort of key verticals that we focus on. And Series A and B was just, we wanted companies that had, like, the seed stage we felt was too early for us, right? We're not going to take something to our enterprise clients if they haven't validated product market fit. So we're looking for sort of post-revenue, post-product market fit where we can now start replicating success with our client base. So that's kind of how we nailed in on that thesis.
Right. And you've described basically what most investors are trying to solve for, which is value add. Well, it gives them kind of a unique advantage over everybody else that when they deploy the capital, it's not just the capital that's creating success, but something else they bring to the table, which is very hard to do. Especially, I'm very skeptical when it comes to corporate investors, being one myself at some point. It's very hard to, a lot can add a lot of value directly, meaning they could be a customer, right? But those relationships usually come with strings, right? And I've seen that play out in bad ways and good ways. You're presenting something a little bit different and unique, which is you're not going to be the customer directly. You're creating more of a channel for potential customers.
Correct. Yeah.
So when you make the investment, do you look for that initially, or do you say, well, this is one of the better companies in the space, and just by osmosis or by kind of naturally, Deloitte, the other partners in Deloitte will find them?
So we do it in advance, but I would say we do it light. Like we don't need necessarily a Deloitte business line to sponsor it. We don't need them to sort of sign on the dotted line that they're going to take this to market. You don't have to have your marketplace relationship in sort of written out and signed off on. But we definitely get the business involved in diligence, and we're trying to get that market lens to say, do you like this? Is this a problem that your clients have? Does the solution solve that problem? Like we definitely get those questions asked and answered by our business partners, and then we'd make the investment. We haven't really had a situation where they've said no, and we're like, well, we're pressing ahead anyways. That hasn't quite happened yet. And then post the deal, then it's the osmosis thing. Go back to Deloitte being a pretty entrepreneurial place. Like we might have validated that with two partners. In the cyber practice, there's, I don't know, 30, 40, like there's a multiple of that, right? And they all manage their own books of business. So scaling that value creation effort and making every partner within the cyber practice aware is very time consuming. And yeah.
Right. When you're looking at a startup to invest in, what is some of the evaluation criteria that you have in terms of the founder, aside from, they feed broadly into your thesis, the right company and the right geography, whatever, right stage? What else do you look for to evaluate the startup?
Yeah, we're looking for pretty high growth. Is obviously like venture backable, right? Is it venture backable? What's the sort of exit multiple on that, right? And so we scenario plan different outcomes, and basically on average, does this give us a 3x outcome, right? And generally, those are companies that are growing quite rapidly. I would say, and also efficiently is really important. So how are they using the capital they've raised so far to grow efficiently? So capital efficiency, just back to my valuation roots, is obviously really near and dear to me. And then I would say, like, we're not always looking for something really like a sexy problem. Like sometimes a really simple problem and a simple way to solve it and getting to market quickly with it is totally fine. So companies that we invest in come in sort of different looks and feels. They don't all have the same through line. Like this is the archetype. We've invested, from $1 million in revenue to 20 million in revenue. So yeah, I would say the vision of the founder is obviously really important, and the founding team and the skills that they bring to the table and their experiences are another element that we certainly rank quite highly.
Right. So what is VC backable in your perspective?
It's the outcome. So I would say
Uh-huh.
for us, it's like on that exit analysis, on a range of different outcomes, let's say 4 to 7 different outcomes, the weighted average of those would give us a 3x return.
I see. 3x return on average, and over a portfolio, some will do better, some will do
Correct.
worse, and yeah, it averages out at
Yeah.
3x. I mean, because usually we in the early stage, like seed stage, we look for fund returners, right? Even better.
Yeah.
But so if I have a $25 million fund, I want to know that the company I'm investing in after dilution and all that
Of course.
can return $25 million. If I'm investing $1 million, that means 25x.
Yep.
Right. So the later stage you go, you need that number to be smaller, that multiple to be smaller, but you still need that multiple to be there.
Correct. And so I would say in our best case scenario, you would see probably maybe not quite a 25x, but you'd see something that would be, a fund returner. And I mean, the weighting of that scenario is obviously like 5%.
5% is pretty high.
Yeah, maybe sometimes
joking,
2%, but yeah.
You're investing later stage, it should be 5% or more.
Yes.
It's funny because when I do scenario planning also, that's kind of our method. And I can't go too much detail, but when I presented those to the folks at Constellation, when we're doing investments, like we were very conservative. Like we had to make those models work with really conservative numbers just because you can't go to people that invest like they do and say, we're going to get 100x on this deal.
Right.
I get fired the next day. But yeah, so that's great. 3x returns. That means what kind of like market sizes? Is it just dependent on the opportunity, or is it like you look for certain market sizes regardless?
I would say there's like, the market has to be big enough. The market has to be, we're not looking at $50 million markets. We're looking at, billions and billions, and something that is global in nature. So, but there's no sort of threshold. We have turned down deals though in the past that are just like, we don't think this is a big enough problem, right? The market's not big enough for this.
At this stage, kind of Series A, Series B and up, the founder, this is my opinion, could be wrong, probably is wrong. Most of my opinions are wrong, for the record.
Okay, well, that's not a good starting proposition.
The founders start to matter a lot less because you have a real business there. You have hopefully an executive team, a competent executive team that picks up a lot of the slack. But the founders still matter, right? And there's a lot of data out there that the longer the founder stays with the business, the better the outcomes are generally.
Yep.
So curious to know at that stage of investing, how important are the founders and how do you evaluate them?
Hugely important. Yeah, I mean, sure, there's a business there. And could you put in a new CEO or someone else that's better suited? Sure. But there's a cost to that. There's a time lag to that. And it's not, we started off about how children are the most important thing to me. It's like it's another child, right? And so the way you care for that when it's yours is just tremendously different, I think, than a hired CEO or somebody to run the business.
By the way, before we started, we talked about what's the most important thing in the world. Talia said her children. I said money and power. Just a difference of opinion,
Yeah. So, sorry.
So how do you evaluate? How do you evaluate good?
How do I evaluate? Well, first of all, one question I like to ask founders is like, what's a good exit? Like, what's a good outcome here for you, right? I like to know how big they're seeing things. So venture backable for me might be different than it is for you, might be different than what it is for them, right? So I just want to make sure that we're all on the same page. I also think understanding, like them understanding themselves, so self-awareness, and them constantly evaluating what their blind spots are and trying to fill and ram those out through other people or through, continuous learning is another sort of key element for me.
How do you identify that, like during the diligence process?
It's hard. It's like valuations. It's more of an art than a science. And so, like in COVID, we did a lot of investing virtually. It comes down to really getting to know people and asking fundamental questions and understanding, why their founders are their founders. Like just in different ways. There's no playbook on how to really find that out. I also would just say, like, we like to invest in good people, right? And again, you might ask me how I would know that. I don't have a good answer to that, but it's a feeling. You got to, in this business, I think you got to trust your instinct a bit. Right.
And hopefully as someone gets more experience, that instinct becomes much more fine-tuned. I've noticed myself, like when I started, I was like, oh, this is like an incredible entrepreneur. And the managing director that I was working for at the time was like, no, this guy's a crook.
Right. Yeah. And that's the problem. I think the way you learn it is, unfortunately, making some mistakes, right? And investing in the wrong ones, and then understanding what the archetype was of those founders, and you don't want to repeat those mistakes, right? So still on a journey. I wouldn't say that I've learned it all, but certainly what we're trying to do.
It's crazy. I remember one of the first meetings I had with an entrepreneur. Like it was I think I was still an intern at the time, my first VC job, and we sit with this really great entrepreneur, and he's bringing this amazing opportunity. I was so excited, and we get out of the meeting, and the principal of the firm and the managing director, and everyone's there, and they're like, "I like him." The head of the firm is like, "I like him. He's very humble." Like that was the first comment about the business. I'm like, "What about the market and the technology and all that?" Like the thing he liked the most was the guy was humble.
Yeah.
What the hell's wrong with these people? Anyways, I learned obviously over time that was a very important point to mention at that time, because this person, like, to do what he's done, he needs to be constantly learning. Someone that really is humble, meaning not meek, that's something else, but someone that understands their strengths and weaknesses and has a desire for continuous learning, that comes from a place of humility. Yeah.
Yeah, agree with that.
So just for my own learning, like, how do you find great deals? Like, where do you go and source the best entrepreneurs? And for the entrepreneurs out there, this is where you need to be, whatever she says.
I would say, so it's a little different for us. We probably get a third of our, my team will correct me, but at some stage, these were the right numbers. It was about a third from our firm. So because we're operating in the cyberspace with partners and technology solutions, like it's part of our job, or our cyber partners' jobs, to understand what else is out there. And so they come across companies and then they bring that to the venture fund. So we get about a third of our deal flow that way, which is great. It's already identified by the business as this is super exciting. My clients like this, so on. A third of our deal flow is probably through, I would say, what comes into us either through our ecosystem of fund relationships. So we're an LP in 7 funds now. And so we get quite a good amount of deal flow from them. And then the last third is just outreach from us, right? We attend a lot of conferences. We speak at a lot of events. We host a lot of events. And so just bringing people together, we meet about a third of our deal flow that way too.
Mm-hmm. So you invest in Canada and the US or worldwide, or what's your geography focus? So
the official statement is that we will invest anywhere. We want to invest in the best technologies that we can bring to our clients. And so wherever that is, we will invest. We have, obviously, being Canadian, and given everything that's going on now, we have a strong bias towards investing in Canada. So towards the end of the month, we will have completed our 10th deal, and 8 out of 10 of those deals will have been in Canada, and 7 of those funds that I just mentioned, they are Canadian.
I see. Okay, very nice.
Yeah.
Obviously, there's some data that came out recently from Canadian Venture Capital Association. The VC in Canada is like stagnant in terms of raw dollars, but in the early stages, which I think Series A is still considered early stage, but I don't know how they break it up. Seed and pre-seed is like dead.
Yeah.
Going from memory, there's been like $12 million invested in Q1 in pre-seed in 22 deals, which is like nothing, right? I just wanted to get your perspective on the venture capital industry in Canada. What's going right? What's going wrong? Anything like that.
Yeah. So that's a tough one. So the data, like the Q1 data, obviously is a little bleak, and all the headlines will say sharp decline, but like Q1's always the softest. So if you actually looked at the data of Q1 2025 relative to Q1 2024 and Q1 2023, it's about flat. Should it be growing? Probably, yes. But it's not declining. It's not like all of a sudden we're falling off a cliff.
The amount of deals have declined, though.
Yes,
like, precipitously.
At the earlier stage, for sure. Yeah. So that, I mean, in of itself isn't a huge scare for me. I'd expect in sort of times that we're in right now with the geopolitical tension that people are a bit at a standstill, right? So I get that. Having said that, though, like I think there's too much foreign investment coming into Canada that should be replaced by Canadian investment. And I also think being a corporate VC should be replaced by corporate VCs to some degree. We conducted a study last year, was our first year doing it. It was the state of corporate venture capital in Canada. And it showed that within companies that generate $1 billion plus in revenue, Canadian ones, about 6% of them have a corporate venture arm, contrasted with 40% of them in the US.
Really?
Yeah. So there are just not enough Canadian corporates investing in this space. You see it also from an adoption perspective, moving from investing to actually being consumers of the technology. You see Cohere. I just did a podcast with Martin Kahn recently from there.
Which you should check out, of course.
And, you know, they talked about Cohere needing to go around to the US and get some reference customers before Canadian customers would speak to them, right? So we're generally more risk averse, and so that's resulting in not so great things. And obviously, investing in sort of the building economy and the venture economy and risk capital is hugely important, I believe, to the productivity of the country and ultimate innovation and the experience that citizens have, right? Consumers in the US have so much choice. They have so much, and as a result of that choice, the companies have a need to innovate at a different pace than Canadian companies do. And the beneficiaries of that are citizens. So all in all, I feel that if corporates play a greater role in this, all boats will sort of rise with that tide.
Right. I find venture capital to be more of a co-opetition model rather than pure competition, meaning if you have a decent reputation in VC, people will make space for you in their round if they like you and they want to work with you. That's what I found, at least. So let's say that we have this, I wouldn't call it an issue, but like a lot of US VCs come and invest in Canadian companies, the dollar's in their favor, and they can get, great investments. And like Toronto's a great ecosystem, right? So if you had more local investments, I think just the pie would grow more rather than splitting up the pie into smaller pieces, right? So that's my perspective. I could be wrong. But why do you think there's a lack of capital in Canada for VC investments?
There isn't. There's actually $10 billion of dry powder sitting. So that's
it's not getting deployed.
It's just not getting deployed. So there is capital in raised funds. I think part of the issue is a lot of fund managers haven't posted any DPI, which is distributions, right?
Actual cash.
Actual cash, right? The IPO markets have been shut. Acquisition activity has fallen. And so there just hasn't been exits at the pace that you would typically see exits for funds in, the 2016 vintage, 2017 vintage, 2018. Like they would have all started harvesting in 2020, 2022, right? So, and that was a wonky time. And then IPO markets shut. So there hasn't been DPI put on the board, which constrains their ability to raise capital. So raising funds is obviously a lot harder now. And so fund managers, as a result, in an easier fundraising environment, they deploy all their capital and then they raise a new fund. Without the certainty of being able to raise a new fund, you want to make the best darn investments that you can. And so I feel like there's a bit of a holding out given what's going on. So that's my personal theory. But
Right. I think the DPI, meaning DPI versus TVPI, for the people that don't understand what that means, venture firms get judged on two things. One is TVPI, which is how much money they make on paper. So if their companies get a valuation markup of 100%, that's called TVPI. DPI is where they actually get that money in cash from selling their shares in the business, which is really what people care about, because what is paper gains good for anyone, right? So what's happened recently, obviously, is that there's lack of liquidity because companies aren't exiting or companies are just failing and not getting exits in general. And so when investors expect to get that money to go reinvest, they get their liquidity back and they go reinvest, it's just not happening as quickly as it should. But that's an issue that also exists in the US. And the US also has a lot of dry powder. But it's interesting that you say that. I didn't know that there's $10 billion in dry powder in Canada. That's crazy. Okay, so what is, like, in your opinion, what is like one thing we could either do at a policy level or VCs, people in our position, can do to change that?
Well, at a policy level, I would say like the adoption thing that I talked about. So being a reference customer for Canadian tech, which we're starting to see, like sovereign data centers now, right? We're seeing the government saying, okay, we don't want to use the hyperscalers. We want a Canadian alternative to that, right? So we are starting to see some of that now. I think that needs to be accelerated. Like, the companies at the Series A and B stages can't really withstand this, an 18-month procurement cycle or whatever it is, right? So accelerating kind of time to use to experiment with Canadian technology, I think would be hugely valuable from a government perspective. And then from a VC perspective, I mean, I continue to advocate for more corporates. That's the stance that I'm taking. But I would say leverage your LPs, right? So if you're fortunate enough to be a fund that has institutional LPs, or have really influential LPs that could help on that value creation story we're talking about, right? It's companies don't just need funds. They need access to clients. They need access to great talent. They need a lot of great things to make it all come together. So help beyond just, being the money.
Right. There's a lot of things that have changed since you started Deloitte Ventures, which 2022 officially launched.
Yes,
Yeah.
correct.
2-3 years. I mean, a lot has changed. Especially I think, with AI tools coming out and making life easier and harder and more confusing.
Mhm.
How has AI changed the way you operate as a venture investor, or how you look at the world, how you look at investing? How's AI changed it?
Yeah, it's a good question. Certainly, we can do more with less, which is again going back to my valuations and capital efficiency background is always great. You know, I would say one of our associates can do the work of almost two associates now, right? Now that you've got all these tools to allow you to learn faster, allow you to pull in the data, allow you to transcribe your conversations. Like there's just so many tools at our fingertips that allow our team to be more efficient at the day-to-day work that we do. I would also say from evaluating the company's perspective, few things. Like if you're an AI native company and you're growing rapidly, like you got to understand whether that growth is sustainable. There's a lot of these companies, they talk about the sugar high, right? And they get to like $1 million in ARR in no time, but you can spike and then you can crash right after that. And so understanding the sustainability of that revenue growth. And that even goes for other companies. Like with the advancement of technology and AI, what is that going to do to some, maybe non-AI native companies? And will they be disrupted? Will that, right? And so I think understanding, trying to answer that question as best you can, which is a really hard question to answer. It's like crystal ball into the future, is the best way about it.
Mm-hmm. That's fascinating. I want to go back to something you talked about earlier on, which is, your family, you come from a family of entrepreneurs. Where did your parents immigrate from, by the way?
Israel.
Oh, very nice. Same here. I mean, I was born in Israel myself, but first generation immigrants, and everybody in my family is an entrepreneur by necessity also. I'm just curious, why did you stay in corporate so long? Was it because you were given all these entrepreneurial opportunities?
Yeah. It's a good question. I would say yes. And I would say because of the platform you have at a big firm like this, your ability to make an impact in some of these areas is way greater. We at Deloitte buy companies, and one of the founders that we bought was like, when I started my business, I was doing $5,000 deals, and then I did $50,000 deals, and then oh my God, one day we got a $500,000 deal, and it was like, holy crap! And then when I got to Deloitte, it was like I could start selling $5 million deals, and then 3 years into Deloitte, I was selling $50 million deals, right? And so she's like, I could have never done that on my own, and so the ability to scale what it is you're doing and have the resources to do that, I think make it potentially more interesting in some ways, while still having that entrepreneurial bent, right? Like I was still scrappy setting up an artificial intelligence business. And then I would say on the venture side, I mean, we set the business up 3 years ago, so it's not really in setup mode. Like it's running now, but the ability to impact founders and help them, given the platform that we have, is hugely motivating and fulfilling.
Mm-hmm. A lot of people I speak to, young people, even older people, they are kind of struggling between launching a business and staying in their safe corporate job. What advice do you have for them to help them figure that out? Like, what should they do? Should they go take the risk or stick with what they're doing?
It's hard. It's I don't think there's one answer to that question. I think again, it comes down to like the conviction, your propensity for continuous growth and learning. Like it depends on you and whether like your capability and succeeding as an entrepreneur, because it's hard. Mm-hmm. Like it is cold out there. Like and that's another reason why I've stayed at Deloitte. Like it's not lost on me that this is the easier path. Certainly for somebody like me, right? Going out, you leave your salary behind, and you don't know where the next thing will come from. Like the reason I stayed was really, my dad asked me. I had all these business cases, as I mentioned, on the side, and he was like, you went to the Ivy School of Business, and you had all the things that I never had. So like, why are you doing this, right? Like he couldn't reconcile in his mind why I would follow down his footsteps, because in his mind, yes, there were times where he was hugely successful, but there were also times where he had to like move our family into, a downsized home and shut a bunch of businesses. And, the competition of the US coming into Canada hurt small business, right? And he felt that firsthand. Our family felt that firsthand, right? And so he's like why would you do that, right? Because there's some more upside, or right? So I think you got to just evaluate for yourself, and your like happiness is also like, to me, super important. Going back to the things we talked about at the beginning, like it's hard to put a price on your personal happiness. And so I would say something that motivates you every single day. If I was waking up every day thinking Deloitte is not for me and I needed to start this business, then I would have left.
Mm-hmm.
The reality is it scratched the itch and it gave me ways to learn and grow in other ways. And here we are, right? So
I'm sure they also give you part of the upside also, right? Like you're a partner there. You've obviously matured into that role.
Yeah. So it's a partnership, and you share in the proceeds of that for sure.
One of the things that I've been noticing a lot is that a lot of people, even in my family, like my younger brother, right? I encourage them not to get a diploma. Like, don't even go to university unless you plan to like be in a corporate job and like you're okay with that and to progress very slowly. It's like, man, just learn something and build a business. Like, don't even go down that path. That's my personal perspective, which is completely flies in the face of like my old school former Soviet Union parent, which is like education is everything, right?
Mm-hmm.
What's your perspective on like, a young person going to get a degree versus starting a business? Like if you could take their tuition and their 4 years, they can start a business with that, or they can go get a degree. What's your thoughts?
Yeah, that's a tough one. I mean, today, just getting a 3 or 4 year degree sometimes doesn't get you really that far. So, certainly, like if that's where you plan to stop, I would say you should evaluate all options. But I would still say like the education route, like higher education, right? If you're going into your master's, your PhDs, or doctorate, or you're becoming a lawyer or an accountant, like professions, I would say still have a high degree of merit.
Mm-hmm.
If you're graduating with no degree of certainty on where you want to do with a Bachelor of Arts, like that piece of paper is not that valuable anymore, right? Even Ivy, right? The pace at which people are graduating and the job opportunities that are on the other end of that, given AI is automating a lot of things, right? There are not as many jobs on the other end of that, and that will continue to decline over time. So I'd give some real hard thought into like what you're going after in terms of your profession versus just like education for the sake of education. I think you have to be much more thoughtful about that.
Right. Even just in this conversation, you mentioned one associate could do the work of two now with latest AI tools.
Yeah.
And there's like a vanishingly small amount of VC jobs out there already. I noticed that myself. I remember I just did like, I need to do research on public market companies. And like I put into Grok and just get me all the data here, put in a chart and analyze it. And it's like, wow, this would have taken me a day.
Yes, it's truly amazing.
It's crazy. And you mentioned also that at some point your parents, like your father, encouraged you, like, why would you even think of going to start a business? How do you think about like the upside? Like no matter what, in a corporate, you're always, you're never going to get as much of the upside as if you were to start the business. How do you think through that decision, the financial decision versus the comfort of knowing that there's a salary as long as you're performing?
Yeah, sure. So like, in the example of ventures or the AI business, like I obviously don't like, I participate in the upside along with all of my partners,
Mm-hmm.
right? But, I use the platform of the firm to get that running. Could I have, a former valuator turned operator turned, hack AI business, something over here, raise $150 million fund? No chance. It's not lost on me that the opportunities that I've had I'm a benefactor of the platform that I'm going
Mm-hmm.
at, that I have, right? So I think it's unfair for us to say we want a disproportionate amount of that upside, right? So it just sort of, it depends. It depends what you value, right? If you value happiness and learning and all that sort of stuff, if you want power and the most amount of upside, right? And like, that's the only thing that's going to satiate you, then yeah, like that, you're not going to get that at likely any corporate, right? Unless you become the CEO and right, and it's a massive company.
Right.
Other than that, like you're not going to build, 100 million, 300 million, right? Without doing some really neat things on the side. maybe if you got into crypto at the right time but yeah, so it sort of, again, goes back to what's important to you.
Right. Also, it's stress levels. It's like, let's say your goal is to get to $1 million, whatever, over whatever period of time. It's like if you get 1% of a $100 million business versus 100% of $1 million business, you're getting to the same place, right? If you're part of a large platform like Deloitte is, you can get the 100 million very quickly, right? If you do everything great, like you did, versus building a business yourself. That's like, man, that's very tough, even to get to 1 million. I've tried many times, and getting there, but I'm saying, like, it's a very, very tough.
That's a good way to put it. I like that analogy.
Do you have any advice for struggling entrepreneurs? It's not hard, not easy to raise money. It's not easy to build a business. What's your advice to them?
Yeah, I mean, the work that you guys are doing, I think, is hugely critical to Canada, and productivity and economic growth and better experiences for citizens. So, like, first off, thank you, because I know it's not easy. Advice: get yourself the right team. I mean, you can't do everything on your own. So, like, your co-founder, I've seen a number of founders, they're like, I'm just going at it alone. It's like, co-founder is hugely helpful. You can't do everything on your own. You're not a master of all that stuff. So find somebody that covers your blind spots. I would say is a good one. Raising capital, like, not for everybody, right? And with AI, like, you may not need to, right? You can accomplish a lot more bootstrapping your business today than you could 3 years ago. So I'd assess that decision wisely. It's more, do you want to build a comfortable business, or you that services you and the needs that you have, and whether it's it could be a profit for purpose motivation or whatever it is, right? Does it solve those things, or do you want to scale rapidly and have this right? So it sort of, again, depends what you're after and whether you go for venture financing. Being capital efficient and scrappy, always. And learn continuously, whether it's podcasts, reading, going out, networking, meeting people. There's endless work to do in your whatever business you're building. But when you go out into the world, like, I find you always learn something and grow. And so, make sure that you're making that time for yourself.
Wow, that's great advice. And Talia, thank you so much for joining us.
Yeah, thanks for having me. This was fun.